So as kind of the last topic in this course, we're going to talk about, well, I would say, uh, what would be one of the main focus of behavioral finance, right? Which is investor settlement. This is a really broad category. It's kind of like a catch-all category. You see, basically, whenever you find some anomaly in the stock market, it's very often that people would attribute it as investor settlement. Um, so where do we start in this topic? Now, assume for a moment that investors hold their investment forever, which is actually kind of a very typical assumption. Investor lives forever in theoretical modeling, so they could hold their stocks forever. Uh, why would you pay money to buy stocks? Like if you intend to hold the stock forever, you're never going to sell it, right? What's the point? Why would you be willing to pay for a stock? The dividend, right? So if you believe that an investor lives forever, then the reason why you might be willing to pay for a stock is the fact that it gives you a dividend. So you can view the stock price as the discount value of future dividend. Theoretically speaking, this has to be the case, right? If you're not selling the stock, then the only reason why you would be willing to pay for a stock is the fact that it gives you dividend in the future. Um, Even if you intend to sell your stocks, this relationship could still hold because whoever takes your stock would hold it for a while and sell it to another person who would hold it for a while and then sell it to another person who will hold it for a while and so on and so forth. So if you combine everyone holding period, you essentially get back the same thing, right? You sell it to someone else. Why would someone else be willing to pay a certain amount? That's because that someone else intends to hold it for a while and then sell it. Well, when that person sells it to a third person, that third person would hold it for a while and sell it to a fourth person, and so on and so forth. So in the end, if you combine everyone's trading and together, you get back this relationship. Right? So the price of a stock should depend on the stream of future dividends, right? On a stream of future dividends. Right. So the field of behavioral finance could arguably begins with this paper by Robert Shiller, 1981 AER. This is one of the most famous diagrams in finance. What does this diagram? What do these two figures show? Well, what these two figures show is the comparison between the actual price of S&P 500 and Dow Jones. So this is S&P, this is Dow Jones, versus the exposed price you would get if you calculate the price based on dividends, right? So the solid line is the actual index, right? So obviously, stock index goes up and down, up and down, up and down, and up and down. So that's expected. That's what an actual stock index would do. The dotted line is the exposed rational price. Now it's exposed because you're using realized dividends to calculate the price, right? You're using the realized dividends to calculate the price. So it's that obviously based on it has the benefit of hindsight, right? So you observe what the future streams of dividends are, and then you use that to calculate the net present value, right, at that moment. So what this diagram shows you is that the exposed rational price is very smooth relative to the actual stock indexes. Right? Actual stock indices goes up and down a lot, but the exposed price is relatively flat. What that means in terms is that dividend is actually relatively stable. Right? You don't get very extreme dividends that is large enough to drive your price around. Okay. So this, as I said, is arguably where behavioral finance starts, because now if what you see, this phenomenon is true, then you have to ask why investors valuations vary so much across time when the underlying reason for paying for a stock does not. Dividends are stable, but prices are not. Even though theoretically the price you pay for a stock is the net present value of future dividends. Right? So why? Okay. So this pretty much is accepted. Well, I mean, there's nothing wrong with this diagram. This is just an empirical observation, right? The explanation you attach may or may not be behavioral, but this is just simply an empirical observation, right? This is simply an empirical observation that the realized price is a lot more varying than what the underlying dividend would suggest. Okay. Right. So stock price is much more volatile than dividend, and as I've explained, this is problematic because theoretically speaking, you pay for stock because the stock price should be a net present value of the underlying dividends. Now, okay, so for what follows, we were going to have a list of research that shows that investors seems to be affected by things that you would think have no direct relationship with stock market, right? What we're going to essentially argue is that investors are affected by many factors besides the underlying value of stocks, which is dividends, right? So if investors are completely rational, then you would think that they would just the price would simply correlate with dividends. But if investors are in fact affected by many other factors, then it would not be surprising to see wide swing in value in prices because investors are being affected by other things. So do we have evidence that investors are affected by other things? And the answer is yes, a lot in fact. So here are some of them. One, there appears to be abnormal return when the sky is cloudy. Now that's probably one of the most ridiculous things you can think of if you think investors are rational. What does the weather on a particular day has to do with stock market return? Well, it looks like it does, right? So in this study, so the dependent variable is a measure of cloudiness, right? The dependent variable is a measure of cloudiness. So this you can get online, right? Cloudiness is something you can easily get, data you can easily get online. So it simply runs an ORS regression of stock return on the measure of cloudiness, right? So each regression is obviously going to be one country, right? So we have one country's stock market return regress on the measure of cloudiness. This table reports the coefficient from this regression for multiple countries. Right. So this is a very simple exercise. Obviously, you should be running a like a regression that corrects for serial correlation, like a new US regression, right? But ultimately, the coefficient estimate is a simple ORS. So you have as many ORS regressions as the number of countries here, and these are the coefficients. Now, if you just look at the coefficients individually, most of them seems to be negative, although few of them are actually statistically significant, right? You can the only one they're like 1, 2, 3, 4 of them are statistically significant, right? You can see that there are only 4 asterisks there. But the fact that because most of them are negative, if you pull them all together, then it's statistically significant overall, and it's negative, right? Okay, so so you have a naive simple average and then value weighted, but the difference is very small. So it's basically if you pull every country together, then it looks like there is a negative effect, which is to say if the weather is cloudy, then stock market tends to go down. That's what it's saying. Now, there are two sets of regression that this paper ran. One is the ORS regression, which means that it used return as the dependent variable. Its return is a continuous variable. There's another set of regression you can see is a logit regression. Right? It's a logit regression. So it's probably just up and down, up and down. Okay, so it's statistically significant. Right, so it's, yeah, you can see, right? The logit regression is just up or down. The logit, so it's reporting the logit coefficients. And if you remember from econometrics, which you probably don't, logit coefficients are very hard to interpret directly. So all you pretty much can say, if they are reporting logit coefficients, is that it's whether it's positive or negative, and it's negative. So if you're running logistic regression, typically it's better to report odds ratio than the coefficients itself, because the coefficient itself it's really hard to interpret. So all you can say is the fact that it's negative. So that's pretty much what you can see. All right. So as you can see, study in this area it can actually be very simple because the regressions are actually very simple here. It's just simple ORS and simple logit. This is things that you have learned even in your intro econometrics, right? They didn't really use anything complicated. They just run one regression per country, right? So it's actually very simple. Despite it's not a very old paper. I mean, it's like 15 years old, but that's in terms of research, that's not particularly old. And it's published in Journal of Finance, right? So the key is that you find a very novel factor that seems to affect stock price, right? Something that people don't expect. Wait, what? Weather on a particular day actually systematically affects stock price? That is something people are really interested in, and the analysis could be pretty simple. Next, this is another one. There's abnormal daily return after daylight saving clocks change. Now, daylight saving is probably that's one of the most ridiculous things to still have in modern time. That we don't have that in Hong Kong. We pretty much don't have that in Asia, right? But in parts of America and Canada, you would adjust your clock twice a year. Once to move it 1 hour ahead, and the other time is to move it backwards. The logic is that probably back in the days when you don't have electricity, you want to make the most use of your sunlight. So you adjust your clock to take advantage of the sunlight, right? But in modern times, with electricity, it doesn't really make much sense anymore, and it's a big hassle because when you move your clock an hour ahead, you lose an hour of sleep, right? Right. So unless you intentionally sleep an hour early. So what it looks at in this paper is to look at the return over weekends. Clock change always happens over weekends. So it looks at the returns over weekends. It basically compares the return over the weekends with a clock change versus the return over all other weekends, right? So each year you have 52 weekends, right? One of them you move the clock forward, one of them you move the clock backwards. So that those are these two, right? The spring and fall. These are the time when you actually move your clock. So the others are just all other 50 weeks pulled together, right? Okay, and so that's a weekend, and these are other days. These are the weekdays, right? So you have weekdays, weekend without clock change. You have a spring clock change and fall clock change. And so what do you see? So they have various measure, right? NYSE, AM, EX, Nasdaq, S&P, and so right. Basically, they basically just throw everything in and see and take a look at whether this applies to different countries, right? And what you see. So first, for weekdays, for returns over weekdays, nothing much to see here. Nothing much to see here, right? Just this is an example of pretty much very precisely estimate to be zero, essentially, right? 0.001. So almost it's very precisely estimated to be close to zero, right? But it's slightly positive. All of them, you see, none of them are negative. Weekends, and now what you can see is that weekends generally are negative. Weekends are generally negative, but the numbers once again very small. Weekends you can see for NYSE is 0.00 negative 0.0007, so that's very small, right? If you look at weekends with clock change, then the effect is like a magnitude larger, negative 0.0018 and negative 0.006. So that's like, this is 10 times larger than that, right? This is like 30 times larger than that, right? This is almost 30 times larger. So this is the case for NYSE, not necessarily the case for the others. This for the effect for S&P 500 is also pretty strong. You can see normal weekend is negative 0.0004. For spring and fall, it's negative 0.001 and negative 0.005. So once again, 10 times larger. Right. So it looks like if you look at the clock change look at the weekends with clock change, the returns tends to be a lot more negative than other days, right? Clearly, weekdays is generally positive. Weekend is generally negative, but unless there's a clock change, the magnitude is a lot smaller. Whenever you have a clock change, the magnitude is actually a lot larger. Right, so clock change means return tends to be lower over that weekend. Okay, why would that be the case? Next one. So what this paper does? So this is so you can see this one is published in 2007, Spot Settlements and Stock Returns in General Finance. All right, so what this study does, well, as the title suggests, this paper looks at how soccer match affects stock return. Now, what they look at is how your national team's performance affect your country's stock market, right? So, for example, they'll be looking at the U.S. team's performance on U.S., the England team's performance on London, right? German team's performance on DAX, right, and so on and so forth. So look at how your national team's performance affects your national stock market. Now, what they do here is not a simple ORS. The first paper we saw, the one on cloudiness, is a simple ORS. The second paper is just t-test, right? They just calculate the average, they just calculate the returns each, and then just run a t-test. This case, it's a bit more complicated because they try to control for pass returns. So what they did is a two-stage least square, two-stage regression. In the first stage, you first regress return on pass return. So essentially, you have an auto-regressive regression, right? You try to first explain return with pass return. Then you take the residual, right? So essentially, what you're doing is let us take the part which cannot be explained by pass return, and then use that as the dependent variable in a second stage ORS, right? So now you have taken away the effect of pass return. You have taken away the effect of pass return, and right, yeah, it's kind of like a momentum effect, yeah. So you're taking away the pass return, and then you regress that on whether your national team has won or lost, right? So they separate that into two dummy variables, two dummy variables. I think this is possible because there are draws, right? Right? I think that otherwise, if there's only win and loss, then you would have a multicollinearity. So I think it is only, I guess, besides there are days with no matches too, right? Yeah, that's why. There are days with no matches. So that's why you can do this, right? So what you have is a time series because matches don't happen every single day. So there are most days probably both variables are 0, and then only on days with matches would you have 1 in either one of them, right? So this is another technique you could use. This is another technique you could use. Now, theoretically, you could run a single regression with pass control. So I think, but it's just probably there are reasons that econometric reasons why they don't want to do that, right? Probably because the error structure is harder to control. So they did it in 2-stage, and what do you see? So okay, here are so remember, beta W is the effect of your national team winning, and beta Elo is the effect of your national team losing, right? So in this paper, what they find is that if your national team wins, your stock market tends to go up. And if your national team loses, then your stock market tends to go down. Now the coefficients are very much in agree. Most of them are in agreement, right? You can see that in the winning case, most of them are positive. In the losing case, all of them are negative. However, if you take a look at the T-stacks, the effect of winning is not statistically significant. It's the T-values are pretty much it's very close to 0. So winning does not seem to have a statistically significant effect. Losing, on the other hand, has very big T-stacks. So you can see that losing does seem to have a very strong effect. If they break it down to different types of matches, right? If you pool everything, then it's statistically significant. If you look at World Cup elimination games, it's statistically significant. If you look at the group stage, it's not really statistically significant, right? And so on and so forth. But overall, if you pool everything, then there does seems to be a negative effect. Why would the fact that your country just lost a soccer match affect your stock market, right? Why would that be the case? Argentina team on Argentina, like German team on German, England team on London. Well, this one, yeah. So this is the same paper. They also look at other games, not just soccer. So as a robustness check, they also look at other games like basketball, cricket, rugby, ice hockey, and so on and so forth. Now same regression. If you look at the coefficients, once again, wins the effect for wins is not very strong. It's not statistically significant. The effect for loss is statistically significant, but as you can see in this case, now if you look at each sport alone, only basketball is statistically significant, Cricket and Ruby are slightly just very close, but not quite open, right? So, but the effect, the coefficients are all pointing towards negative, so that's very suggestive. Okay. Right. So now the problem with the reason why there's the other paper I want to mention is this particular paper, while it documents an anomaly, is not something that you can use as a trading strategy. Why? Exactly, you don't know which team's going to win or lose, right? So that's why it's that's why there's a next paper, because this paper, while documenting an anomaly, does not really give you a viable trading strategy. Now for the other ones, right? For cloudiness, you could look at weather reports, right? Weather forecasts, right? So you could use daylight saving effect. This is predictable because it's well announced ahead of time when the clock change is going to happen. So for the previous two papers, you can actually use them as a profitable trading strategy, but not this one because you don't know which team is going to win or lose ahead of time, right? So that's why there's the next paper that I for some reason didn't actually put in this slides. And right, so now whenever whenever you see investors seems to be doing something irrational, you see the stock market moving in ways that you cannot explain rationally, then you tend to very often people would say this is investor sentiment. But it's basically saying that people kind of it's just a more cool way of saying that people doing things weirdly, right? Right. So you don't want to say investors are weird. You don't want to say investors are irrational per se. Then you say they have investor sentiment. Right. Makes it sound more academic. But essentially, you're saying that you find people are doing something weird, and you need some way to explain it, right? So let's go back now. We'll go back to the papers we have talked about up till now. The very first one, Robert Shiller's paper, just shows you that there is a component in investors' valuation of stocks that is not based on discount stream of dividends. Right? Dividend is very stable. Price is not. So there must be a component that is not stable, and that is not dividend. Right? What that is, Shiller doesn't really say. Right? That's 1981. Next, we have these papers which talks about it seems like people get affected by various factors. Now, if I ask you to explain why the stock market, and actually pretty much all the papers we look at just now have a negative effect, right? Cloudy weather, stock market goes down. Clock change, stock market goes down. Your national team loses, stock market goes down. There's a World Cup, stock market goes down. Why? Like, if you need to come up with explanations for each of them, what would you say?
People are unhappy.
Yeah. Essentially, it all comes down to people being unhappy. Weather is bad, I feel down. I don't want to buy stocks. So stock market goes down. Right? Clock change, I don't have enough sleep. I feel bad. I don't want to buy stocks. Stock market goes down. The national team loses. I feel really bad. I don't want to trade. Stock market goes down. World Cup, you know what? I'm not coming to work today. So no one buys, stock market goes down. Essentially, it comes down to things like, people being unhappy, you can say, right? So another way you can approach this type of study is that think of something that you think would make a lot of people unhappy, and then you can use that to run a study and see whether it negatively affects the stock market, right? So there are a lot of potentials. I think there are a lot of potentials there. Like especially if you look at regional stock markets, there are probably things that happens to a particular country or region that makes people in that region particularly unhappy, and chances are it probably affects the stock market. Right. So when people also if the stock market goes down because people are unhappy, then we would call that investor sentiment, because there's some kind of like a emotional component in stock valuation, right? And that's called investor sentiment. Now, do we have evidence that there is actually factors that affect a large number of investors in a market simultaneously? Right? That's kind of what we are explaining here, right? Soccer match makes a lot of people unhappy, so stock market goes down. Bad weather makes a lot of people unhappy, so stock market goes down. Lack of sleep makes the whole country unhappy, so stock market goes down. So do we have evidence of that? That investors seem to be doing things at the same thing at the same time. So there's this paper use Odin's discount brokerage data. So what they did is they formed 1,000 pairs of random non-overlapping portfolios of stock. So in the slides I initially gave you, it says 1,000 random non-overlapping portfolios. That's not correct. 1,000 pairs of portfolios, right? So it's 2 at a time, right? They form 2 portfolios at a time for 1,000 times, because obviously it doesn't make sense to form 1,000 non-overlapping portfolios with hundreds of stock in each. So it's 1,000 pairs of random non-overlapping portfolios. So it's 2 portfolios at a time and repeated for 1,000 times. So what they did is, so
these in the portfolio, the pair portfolios, all of them have stocks that are non-overlapping.
Yes. So if I need to form 2 portfolios, if I randomly draw those stocks that are in portfolio A would not be in portfolio B.
But those in portfolio 1 and those in portfolio 1,000 might be.
Right. Those in the first run and the 1,000 run might repeat. So what they look at is buy-sell imbalance. Do you have more buys or more sells among the stocks that you happen to pick for the portfolio? Right? It's just more buy or more sell. Now, what they did in this paper, what they looked at is a fixed period from 1991 to 1995, I think. So it's a fixed investment. Just look at 5 years, right? I think something like January 1991 to like December 1995 or something like that. So yeah, they just look at fixed period, right? So within that period, do you see more buys or more sells? Right? It's a percentage. No, it's a dollar term. Sorry, it's a buy sell imbalance. So it's buy dollar terms minus sell dollar terms. Right. And then you control it with market return. So you expect more buys if the market is generally going up. So you just run an ORS regression and look, once again, you run an ORS regression and look at the residual. So this is, as you can see, it's a common technique. This is done here and done on soccer paper, right? You run ORS, control for things that you think are important, perhaps market index, perhaps past return. You remove all those effects by looking just at the residual, right? Just looking. So they're looking at the residual. Looking at the residual. All right. So, and then, because what you have is many portfolios, 1,000 pairs of portfolios, right? So you have 1,000 correlations. You have 1,000 correlations. So what you have is something like this, right? Draw one. You have portfolio A, portfolio B, right? In this case, you could have stock 1, stock 2, you could have stock 3, stock 4, right? Then the next, in draw 2, you could have stock 1, stock 3, stock 2, stock 4, and then you run it in 3. It could be right, stock 2, stock 4, and stock 1, stock 3, right, and so on and so forth, right? And you will run it for 1,000 times. You can calculate the correlation, right? You calculate the correlation between each of these portfolio, and then there will be 1,000 correlations, right? And they plot these 1,000 correlations. what they did. Randomly draw stocks 1,000 times into and you have split into two portfolios. Calculate the correlation between the two portfolios. You have 1,000 correlations. Plot that. Right? They did. They all formalize it with respect to market return, but that's basically the idea. What do you see? So if you want, just ignore the part that they organize it with market index. Just think of it as correlation between two randomly drawn portfolios. And what you're going to see is the correlations are not going to be zero. It's that you can see that the median is somewhere around 0.6, right? So it's all positive. It's positive, and then it's the median is 0.6. What that says is, if you randomly draw stocks, now remember this is using Terence O'Dean's data, so it's based on, once again, the trading records of discount brokerage, right? So what this says is that if you randomly look at two stocks, randomly look at two stocks that people buy. Chances are, when people are buying one stock, they are also buying the other stock. Or when they're selling one stock, they're also selling the other stock, right? So the trading behavior of different stocks seems to be moving in the same direction on average, right? That's why the correlation is positive. When one stock has high demand, another stock also tends to have high demand. That's what this paper is trying to say. Which is not something you necessarily expect. Because now, if you don't control for market index, then that's possible, right? Because stock market is, perhaps when stock market is good, then all stocks get lifted, right? But that's why you have to orthogonalize it with respect to stock market index, because you want to remove the overall effect. So the thing is, if you think about portfolio balancing, there's no reason why you would expect multiple stocks to have the same demand movement at the same time, right? If I'm balancing my stocks, then I should be, when I buy one stock, I probably selling another stock, right? That's rebalancing. Buy one thing, sell one thing. But that's not what you see here. What you see is when one stock has higher demand, other stocks also tend to have higher demand. Right. So there seems to be some underlying factor driving the demand of stocks to move in the same direction. Now, so once again, you can see that the statistical technique here is not complicated, right? It's actually not complicated. It's just randomly drawing stocks, splitting them into portfolios, calculating a simple correlation. Do this many times and plot correlation. This is something that's the statistical technique is actually not very complicated. If you remember, like Charles Lee is the accountant that I work for. He's an accountant, so the statistical technique is obviously not going to be very complicated, right? So, in fact, yeah, like yeah, so.
So the expectation is 0, but then this graph shows that it's not.
If you think people, I'm not too sure what you should expect, but yeah, but I would say, yeah, like if people are balancing in a way where you buy one thing, you sell another, like you just keep it, then you wouldn't expect it all to be positive after correcting for the market movement. Right? After correcting for the market movement, then it should be kind of 0. Without correction, then yeah, it would be positive, but after correcting for market, it's hard to see why you still have that demand, rationally speaking. Because when one stock is doing well, then I mean, stock performance is relative, right? If I think this stock is doing better than that stock, then I just buy more of this stock and less of that stock. I don't see why you necessarily need to buy, after correcting for market, why you need to buy multiple stocks.
Diversify. So,
Well, but you have control already control for the market. You've already control for the market. So what they want to show is that the investor demand move in synchronization. That's what they want to show. But if you want to diversify, you actually, yeah, like if you want, it shouldn't still be all positive, right?
yeah.
Like it should be there should be a lot more closer to zeros, right? Now, I think another thing to note is that this is a small investor. This is a small. This remember the Odin's data is small investor, not institutional investor. Diversification is not their cup of tea. So what you see here is almost certainly not diversification because these small investors typically hold individual stocks, right? So what you see is that different investors tend to buy and sell together. That's what you see here. Yeah, if this is institutional investors, then it could be diversification, but small investors typically hold individual stocks. So what you see is different investors moving together.
But maybe it's just that retail investors buy more than the market. The market I think increased by 1%, the retail investors by 10%. There are lots more.
But that's okay because you're using ORS to control as a control, right? So let's just say retail investors are just it's just magnifying the effect of the overall market. Then we just have a bigger beta. You'll still be able to control for it with ORS, right?
So what if they're buying at all times? Even if the stock market is going down, they're still buying. They just keep buying. They just keep buying.
That's a good question. So if they just keeps buying, well, basically what you say. Well, I guess this doesn't necessarily. I think you can still apply the same story. That what you're focusing on is the fact that different investor tends to buy different stock at in the same. Different investor tends to buy and sell different stocks in the same direction at the same time, right? When I buy stock A, you also tends to buy stock B, right? So if they all buy they're always all buying, you will not be recruiting the story, right? Our behavior is still highly correlated, right? Although in that case, yeah, it might not be saying much because then they're just always buying, right? It's still agree with their story in that what I do has high correlation with what you do, even though we might be buying different stocks. Right? Yeah, but it will be a lot less interesting because there seems to be no market timing there. Right? This story will only be interesting if when I buy stock A, you tend to buy stock B, and when I sell stock A, you also tend to sell stock B. That would be much more interesting because it seems like our market timing is correlated. If we both keep buying and whenever selling, then it's still agree with their story, but it's not very interesting because there seems to be no market timing there. Yeah. So what they want to say is the story that when I buy stock A, you would tend to buy stock B. When I sell stock A, you tend to sell stock B. That's what they want to say. All right. So this is an observation of, as I said, they're trying to explain that there seems to be very high correlation between people's buying and selling behavior. If you are the type of finance professor who always have industry application in mind, then you always want to do something like this. After discovering an anomaly, you want to see, is it possible to use it? Is it possible to use it? And in this case, what you do is, once again, in this case, very standard Farmer French-like type of controls, right? Separate your all your stocks into five, groups, right? Five quintiles, 1, 2, 3, 4, 5 by size, right? And then you have to control for RMRF, market excess return, RM minus RF, right? Market excess return, small minus big factor, high minus low factor, momentum factor. So as I said, after Farmer Branch, the standard is you have to control for 4 factors. After controlling for 4 factors, do you still have to add in your own factor, right? So you have, remember basically what you run is within each portfolio, you run an ORS regression. The ORS regression would have an intercept, the market excess return, you have the small minus big factor, high minus low factor, and momentum factor. So at the minimum, you have 1, 2, 3, 4, you have what? 1, 2, 3, 4 independent variables. After that, you add in your own independent variables, whatever you think is going to predict the stock market. At that end, run the ORS regression for each portfolio, check if your factor still have a statistically significant coefficient. And in this case, yes, but only for small stocks. Right. So in this case, what you see is that, well, after controlling for everything, this buy-sell imbalance measure can predict return for small stocks, which for them is okay because they want to say that this is all about small investor behavior, right? So it's reasonable that the factor only predicts small stock return. Small investors tend to like small stocks. That's what they think. That's fine for them. But what you can also see is that that's why the reason why you have to control for these factors, because you can see that these factors have t-stacks way larger, except for momentum. You can see that the Farmer French three factors models have t-stack way larger than pretty much anything you can put in additionally. So that's why you always have to control for these factors first, and then you can put in whatever you want and see whether it still has an impact.
So we can still trade with like the 3 factor.
Yes. So you can trade with a 3 factor model because you can if so that's part of the reason why you have to control for a 3 factor model, because if your recommendation is concentrate among small stocks, then you would expect to have a high return because we know small stocks tend to have high return. Right? Similarly, if your recommendation is concentrate among high book to market firms, then you know that it's going to have higher return on average. That's something we already know. Or if you tend to recommend stocks that have been doing well in the recent past, then we know that it should have relatively good returns because that's momentum, right? So even though your factor might not be these factors directly, it could be highly correlated, right? Highly correlated, right? So think about it, right? Let's say I recommend stocks that have appeared on the news frequently in the recent past, right? Now that might sound like it's different, but if stocks that have been doing well in the recent past appears on the news more often, then I recommend stocks that appear on the news, then you can see that there will be very high correlation between the two, right? Stocks that do well appears on the news. I recommend stocks that appear on the news. So essentially, I am recommending stocks that have been doing well recently. So essentially, my strategy is simply a momentum strategy. So that's what you have to control for that.